We are live. Good afternoon, everyone. Happy Friday. Rich Swerbinsky with the Mortgage Collaborative here with the Rundown with Rob and Rich. And once again, we are thrilled to be joined by longtime TMC partner, no pun intended, Partners Credit, and their COO, Tracy King Donadio. Tracy, we got a lot of positive comments about your appearance last week on the show. So thanks for joining us again.
I'm super excited to have been here. It's been a great platform, and I love the conversation, and hopefully I won't stumble too many times. Each week I get a little bit more comfortable and ready to dodge questions and see how I can field them.
So Tracy, before we started this up, you were asking me if it was okay if you asked Rich about his combination Studio 54, the Munster set that was going on behind him there. I think you should feel free to ask him why the Silence of the Lambs basement look here this time around.
Yeah, I guess what is happening there? I think you asked the question, so I'm glad to ask it as well. It's party lights, it's dungeon-esque, it's exciting.
Yeah, I'm sick. Cleveland Februarys, if you haven't been home for a year straight, are tough to withstand. I'm just going crazy. I'm trying to get to different parts of my house. My office was always in the basement before the Zoom era exploded. And, I moved to other parts of my house, but I'm like, you know what? I'm resuscitating the basement because I'm just sick of looking at the other parts of my house. And, as for the, Boogie Nights theme, I don't know what to say there.
Oh,
Rich, along those lines, and I know you want to talk about business pretty soon here, but I make these jokes in my commentary about, I really mixed things up. I sat, on the opposite side of the dining room table to put out my commentary this morning. That's not far from the truth. Even like a little different part of the house is good. In fact, I drove all the way to San Diego just for this just for this show today. So I'm in San Diego right now.
There you go. That's great commitment to this program. Although San Diego, right? That's right
from Hawaii to San Diego. You just really don't hold back when it comes to your commitment to making something.
Yes.
Yeah.
TMC
visiting my son Robbie down here for a few days.
Nice. And I've enjoyed listening to him on your podcast versions of your daily commentary, seriousness. It's been great. I mean, I read your commentary every day, but now I know I can just click and listen in the background as I'm doing other things. So it's a nice addition. So
I know that you're a gourmet cook, and maybe when you're preparing a meal or something, you put that on in the background.
We're about to launch soon here, TMC, submit your most awesome recipe contest that we're going to run for a little while that I'm pretty excited about with some cool cooking related prizes. So, but I do love to cook, and I love San Diego. Never a bad time or reason to go to San Diego. TMC's based out of San Diego. I always jokingly call Cleveland the San Diego of the Midwest.
Jokingly is the key word.
Right. All right, we should maybe get into it, but I want to thank everybody for joining us this afternoon. This is the Rundown with Rob and Rich, every other Friday, 3 p.m. Eastern. And once again, we are thrilled to be joined by Tracy King Donadio, the COO of Partners Credit. And let's start with credit because it's a big issue right now in the industry, something that's generating a lot of chatter and discussion, and it's the potential of some sort of centralized credit reporting system. I did see a couple days ago, and encouraging for those of us that don't want to see that happen. I think it was the American Financial Services Association. The head of that organization came out and made some comments about how it would just be almost financially and logistically impossible, even if that's a direction that the Biden administration wanted to go. But I'll open with that. We talked about that, Tracy, last week for probably the first 15 or 20 minutes of the conversation. And let's start there. So any further thoughts on that issue? Anything related to the topic at hand?
I mean, I've been thinking about it more and more, and kind of, another reason why I love these conversations, this is my world and what I do, and to hear different perspectives and how people are looking at this or being worried about this, it kind of gets my brain moving again, of thinking about what this all means and how it means to get to the consumer. And I think, a lot of great questions have been raised. And I think going deeper into this, it's hard to kind of talk about it in a way to not politicize viewpoints or project what I think, or just talking about it in general. So I'm going to try to do that as much as possible. But, the question of the credit bureaus versus a credit score, those are different things. And how we're looking at, when you're talking about how we look at a credit score to value a consumer, the credit bureaus, have to use a FICO score in this kind of environment for mortgage lending. So having the CFPB take over credit bureaus and just having that one entity, or however they're going to do it, or thinking about doing it, it's just so much more complex than that. And we got to it in our discussion as well, as to, what does it take to create a score? And so if you're going to have a conversation about fair lending practices, or you're taking a look at what it means for a borrower, and a lot of the conversations of what does a credit report have and what doesn't. And Rob had followed up with me after one of our conversations, asking these questions of, it doesn't look at race, it doesn't look at your age, sexual orientation, all of those things when you're doing it. But if you kind of trickle back and look at access levels to different types of credit, how things are scored, what those scores are weighed upon, it's not necessarily holding that data and who holds that data, it's how you're responding to it. And also, I guess, how it is reported to the bureaus. So what kind of creditors are reporting that information to the credit bureaus, and then how are they scored? So it's not just Experian, Equifax, and TransUnion, it's the score that comes from it. It's how you evaluate that and how you're using that model. It's how that data gets to the bureaus, who selects which is a financial institution that you can deem worthy to have on someone's credit file. So it's a much bigger picture. It's just simplifying it a little too much. There's all these external spheres that are all around this. And even though they are the holder of the data, there's so many different impacts of how they're getting it and how it is interpreted, and how someone can be determined worthy or not based upon that data. So,
what's interesting to me, and maybe I used this analogy in our last session. Maybe I didn't. I don't know. Hope not. But recently, I wanted to cook some steak, so I opened up this Bobby Flay cookbook and found a recipe for steaks, and there were like four or five ingredients, steaks and onions or whatever it was. Then the last ingredient was 2 tablespoons of Bobby Flay's special seasoning.
right.
Turn to page 283. So you go to 283, and literally Bobby Flay's special seasoning has like 20 different, cayenne, turmeric, and brown sugar, and just like, and it, mix it all, and then let it sit for a week, kind of thing. And it's like, holy smokes, it was very complicated, more complicated than I really wanted to deal with. When you look at originating a mortgage, it's the same thing. If you're, we have originators on the phone here who are dealing with consumers, borrowers, with this push button get mortgage kind of attitude, kind of like, why isn't it so easy? And when you go behind the curtain, like you're explaining, just the process of coming up with, somebody, a loan officer might tell the borrower, oh yeah, we get a credit score, and then we do this. Well, just to get that credit score isn't a simple matter. And people in the industry, I think, are tangentially aware of how difficult and what's kind of going on behind the scenes with regard to credit. But I mean, you just touched on it, how there's a lot of moving parts that people don't realize, not only the consumer, but also people in our industry, underwriters, whoever it might be. And you have a ringside seat at Partners, looking at all this that's going on and keeping abreast of it. It's very, very complicated. And then in the secondary markets, you can't, so much of you being able to sell a loan or a pool of loans in the secondary market is dependent upon the credit of the borrower, and making sure that credit is accurate and takes into account whether or not, they've been not only making their payments, but can they make their payments? I don't know. But, evaluating, I know Anita Padilla Fitzgerald recently was talking about, or reminded everybody about, there are borrowers out there who, maybe you should look at their utility bill. Maybe they have no credit cards. How do you evaluate the credit of those people, not only to process the loan, but to be able to sell that loan in the secondary markets? I think it's very important. So Tracy, you hit on some great points there.
Yeah, and talking to some people, and we talked about this before, of is it to benefit the lender or the investor? Is it to benefit the consumer? Where should the priority be? And the fact, we had a conversation about a thin file that you don't necessarily need a score to submit. You can manually underwrite it. It's just more challenging, and it puts more risk at the initial lender that it could come back on their books. So there's more hesitancy to do that. So I think there's openings to look at how, different ways of looking at it. But in thinking of your Bobby Flay analogy there, it's also, you can look at, there's all these different layers of how you can get that special seasoning for his thing and do it on your own, or you can just go and get his recipe, or you can get his pre-made mix. And I think we're so used to things just being done the way that they are, and having this one score that we're using, that it's too complicated to get into, and you're looking or focusing on potentially the wrong thing. If we're talking about how we do look at this systematically, of how scores are looked at, how they're generated, why it's being focused more to the bureaus versus, how we get there and work for the consumer, who ultimately we're trying to help. It gets, again, complicated.
So I have a question. I have a lot of questions, but let's say you are right. You get on an elevator on the 30th floor, and somebody gets on, the elevator with you, and he's trying to chat you up a little bit. Actually, this is a bad example. Let's say you're telling your grandmother what Partners does. What is the elevator speech? What is the quick and dirty about what Partners does? What do you tell people that you do?
People that aren't in our industry, I tell them that I work with mortgage companies, lenders, credit unions, and banks. And when you go and buy a house, they have to get a bunch of information about you, and I help supply that information. And personally, I help figure out how to help them operate smoothly, and figure out the best of how to keep my company doing its best and offering what it can do, and working with lenders to see on their end what complications they're having and how I can make that go smoother. But basically, I'm a lady with some data that people need to get a mortgage loan.
I have a question, and I feel like I should know the answer to this. Experian, Equifax, and TransUnion. Like, who anointed those three companies? Are they overseen by some entity? What prevents a Partner's Credit from, becoming the issuer of credit scoring and bureaus that others resell. What I
Well,
don't.
there used to be a bunch of different bureaus. I know they've all kind of gone away over time. I guess know that, but I don't. I can tell you, even in our market for a credit reporting agency, there used to be, hundreds of them. Now that's dwindling down. And because of licensing, because of, and I should know this as well, but restrictions, if you wanted to start your own CRA, you wouldn't be able to do it anymore. They've restricted starting this as a new entity. So if you're in, we're locked in, but it's also a diminishing entities out there with competitors. Everyone's kind of going out and merging with others, or others have kind of dwindled away over time.
This is the Rundown with Rob and Rich. I'm Rich Swerbinsky with the Mortgage Collaborative, joined as always by Rob Krisman every other Friday at 3 p.m. Eastern. And pleased this week to be joined by Partners Credit COO Tracy King Donadio. And we're talking about credit reports, credit bureaus, and changes that could potentially be afoot in the weeks, months, years to come with the new presidential administration now in office. And Rob, any feedback from your column? I know that you've written about this a couple times, and have noted that it generated some feedback that you posted in your commentary. What's the pulse of Joe mortgage lender out there, at least from how you hear and see it?
In the last 24 hours or before that?
Just, in general. In the last 24 hours, it's probably all rate freak out. Secondary guys and gals that haven't hedged their pipeline correctly. I don't know.
It's hard to argue with what's going on in our industry now and say that there's a lot that needs correcting. It's terrible. There are people, companies are running amok out there. They're they have illegal MSAs. Their LO comp plans are bad. Yada yada yada. Because those were the stories that we were hearing years ago. The overall industry is doing very well right now. We're coming off what could be a record year for volumes, for margins. Lots of originators, individual originators had compensation levels north of $1 million. So as an industry, we're doing well. We went into 2020 in very good shape. Pipelines were still full. So a lot of companies had record-setting Januaries. The jury's still out on February, but I imagine February will look very good for a lot of lenders. So it's hard to be too much of an Eeyore, to gripe too much when pipelines are still full. We are satisfying hundreds of thousands of borrowers across the nation every month, helping them save money or helping them buy homes. So as an industry, I think we're in very, very good shape. Now, there's going to be a lot of tweaking that goes on, as you know. We've talked about the CFPB. We've talked about the regulatory environment in general. We still have the state regulators who are out there doing whatever state regulators do. Then yesterday, you're right, we had the bond market. So I shouldn't say the bond market, but we had some volatility. And overall, though, I would say that the people that communicate with me, besides griping about this or griping about that, we're in pretty good shape. And I think industry veterans realize that and trying not to take it for granted, because at some point it may change. At some point, rates could go up. At some point, we could lose hundreds of thousands of potential refi candidates because rates go up. So they understand that margins may shrink. You could have a situation where, we've staffed up for these volume levels, and gosh, Rates have moved up, and the pipeline isn't as full as it used to be. And we're getting a little bit of slack time. A little bit of slack time is good, because as an industry, so many people have been working, 6 or 7 days a week to help borrowers, and at some point you get burned out. So a little bit of slack, a little bit of downtime, seasonal downtime, perhaps, would be a good thing. But at some point, enough's enough, and you'll start to see margins start to shrink. We already saw a little bit yesterday. There are lenders that I looked at that didn't price the entire mortgage-backed security move into their rate sheet. They let the margins shrink a little bit to try to cushion that blow somewhat. Maybe it'll widen back out. But I think if you had to put your finger on one kind of concern out there, I would say it's with regard to interest rates. And I didn't have loans that I had locked in. Somebody told me to float, and it didn't work out. So now what? I put all this work into this loan, and now it doesn't make sense for them to refinance anymore. Now granted, the market has returned a little bit, has bounced back a little bit today, as you would expect. But I think that's the big concern out there, that rates continue. The pressure on rates is more toward the upside than the downside right now. So I think that's the concern.
One of the taglines of the now famed Wall Street Bets forum on Reddit is "Stonks only go up," but like with mortgage rates, like they can go up. Who knew? Like it's been forever. I mean, they were, I guess, up in the high twos in August, but they've been in the low to mid twos, 30-year fixed rates for a long time. We've seen some upward pressure in bond yields, which obviously impacts mortgage rates. I think that's happening just because I think, the market is starting to get a little freaked out. All this stimulus and, everything that's been going on right now in the economy, that even though, people have been worrying unnecessarily about inflation my entire career in the industry. It started on the capital market side, but now it appears like there are some legitimate inflation fears that have kind of caused this bump up. Just anecdotally talking to some of our members this week, this was not a good new application week. The first drop off week, I heard from some lenders it was really noticeable. And I don't know, Tracy, I'll start with you. Just your sense of, I keep seeing these reports from, Black Knight and other large servicers that there's like 800 trillion of still refinanceable people out there. I don't even know how that is possible with how long rates have been low. And, we're in a quarantine. If you don't got the time to figure out how to refi on your computer or your phone,
Right.
I mean, come on.
Yeah. What have they been waiting for till now? Yeah.
I'm of the belief that forget these stats that we go to 3.25%, 3.5% on a 30-year fixed. It's about over for refis. Outside of people that need to take cash out or something like that. But Tracy, any sense of that claim? I mean, what do you think about the still to be refinanced market?
Well, from what I've talked to about from people, you have those that have been hesitant to do so. I think that if you're not in the know, we're so used to this being a day-to-day thing and people hearing what rates being low means. I do think that if it continues to rise, people are going to come out and think this is their last chance to do it. If they haven't done it before, they might not have recognized the benefits, or if they've now talked to friends that went through the process and what that looked like for them, whether it was easy or difficult, or what mattered or didn't. And potentially some people stayed out of it because they were worried about their job, or they talked to an LO where, they're talking about not only your credit history matters, but your income and what that could do. So if people have maintained their their job or got back into the workforce, now is the time that they can potentially be approved for it and be able to move forward. So I think, we've seen a bit of a dip in volume, not significant in any kind of way, but I do think that people are still working the pipeline, and people still had a lot of backlog. I mean, even though they've been able to ease up a bit, there's a lot that longer turn times that they've had, that we've had industry wide. They're still trying to work through this. And I do think you're right that I think we've all appreciated the boom that we've had, obviously, and Rob talking about that, of people having like the best years of their career, but it was at a frantic pace where, even though we're happy for the successes, it'd be great to take a breath at some point. But that being said, I think there's a lot of fears. And while you were talking, I'm thinking about when I was talking to customers, staying busy and going through COVID and worrying about staffing levels, and staffing up, but also kind of poaching people at really high salaries to try to get them over to fill those seats. I think that's something that people are going to be looking at and considering. That was just kind of a side note tangent, but one that I know it's coming up for a lot of people. But I still think there's space there. And I know that a lot of people have talked about, second quarter, maybe third quarter is when we're really going to see the change in the dip. Do you guys see that? Are you anticipating that sooner now? I know a lot of people were talking about third quarter before, but do you predict earlier?
Well, Rob, real quick, in the chat, somebody said McCormick's Montreal steak seasoning. They put it all in one little bottle for you. It's like $4. So it's a good time for me to remind everybody as well. Obviously, any comments, questions, jokes, anything, please feel free. Very non-pretentious show here, and we'll put it in the chat of the Q&A, and we'll voice it aloud. But Tracy's question is valid, Rob. So almost every projection by any economist of note coming into this year was that refinances would be cut about in half, 21 versus 20. That was based on a slow climb from 2.3, 2.4 to 3, up, getting close to where we are now on the 30-year fixed rate. If 30-year fixed rates continue to climb, and we're 3 1/8, we're in the low 3s on the 30-year fixed, and slow climb into the mid to high 3s, so worse than projected. What is your sense of just the refinanceable market from your seat? There's still huge opportunity. Are there a lot of people out there, as Tracy notes, that, because she makes a good point. We're plugged into this every day. Like, I sit here and joke, like, who the hell could not have refinanced by now? But I look at this crap every day. What's your sense of this?
My sense?
The refi market, not steak seasoning.
I would be, I'm in this industry tangentially. I would be hard pressed to tell you what my mortgage rate is. I think that a lot of people just don't think about it. And when I see statistics, these grandiose statistics about the refinanceable market, I always think back when I talk to originators that they will warn me against just accepting those figures. They'll say, well, not all the areas of the nation are seeing a lot of price appreciation. So they may not have enough equity. They may have credit issues. They may not want to refinance because they don't want to go through the hassle. Maybe they are thinking about selling their house in another month or 2 or 3 and just don't want to deal with it. Whatever it might be, or they just don't know their rate. And yeah, they're bombarded, whether it's, looking at a bus stop advertisement or a Super Bowl ad. Yeah. There's a lot of mortgage out there. I kind of think that maybe I just noticed the mortgage that's out and about and advertising all that because I'm in the business. Maybe a lot of people just don't see it. But nonetheless, to Tracy's point, I think that companies are still backlogged. They're still hiring. They're still trying to add ops people. They have the ability to do that. And Rich, don't forget, at some point, you know, it's a little more complicated than me just saying this, but at some point, cash out refis and home equity programs are going to come back, especially in areas where people aren't going to move. They've seen a lot of appreciation in their home. Maybe they want to buy an RV. Maybe their credit card has run up. Maybe they have been dipping into savings during this pandemic. And so you have situations out there that lend themselves to other kinds of financing, whether it's cash out or HELOC. And so, and I will say this, independent mortgage bankers are very, very entrepreneurial. They are savvy business people, and they will, you know, this is their whole focus. They're not like commercial banks, depository banks that have, you know, a car loan department or a, you know, credit card department or different sources of revenue. Independent mortgage banks have one revenue source, and that's lending like this. And so I think, you know, the industry will continue to do well. You're right. In the second quarter, third quarter, things may start to peter out. I mean, I don't think anybody will be surprised when it does, because as they say, no tree grows to the moon. Eventually a gas tank runs out of gas. You know, it's not like we could keep up 2020's pace for years and years to come. So it'll slow down, which brings up a point for probably another session, but it'll interesting to see how senior management works in an environment where that is happening. You know, it's pretty easy just to go out and hire people and well, relatively easy to hire people, train people, whatever. But, you know, if we do get into a contraction or a slowdown, managers will have to make some tough decisions about personnel that they brought on or that they have. Do lenders want to keep on originators who are only doing one or two loans a month, 3 loans a month? You know, do they want to keep those people on? You know, what's going to help them get to that next level? So I think management will have some interesting decisions to make in the second and third quarter, but I wouldn't be surprised. I don't think anybody would really be surprised when we see the eventual slowdown.
I think to what you're saying too, I mean, there were refis prior to 2020, and there are institutions that were focused solely on refis. And, you know, I know a lot of lenders that were kind of like, you know, they're not doing any marketing for a while because they couldn't take on anymore, and were almost kind of backing away or raising their rates so that they could maintain what they had. So I think it's seeing, you know, before the curve, here we are. How are you going to use kind of what you've earned in this last year to market yourself and get yourself out there? To your point, Rob, of some people don't know what their rate is. Some people don't know what a refi entails or what they have access to by doing that. Of, you know, is it just to lower my payment? Is it to get something else? We do kind of live in our own bubble. And how do you market yourself to reach out to those consumers where there still are opportunities? And you just have to think a few months ahead. This isn't going to last forever where you're turning people away, or you don't have to, you know, spend the dollars to get them interested in coming in. Now, how are we going to move forward? You know, how it was before, where rates were where they are and people were still refinancing during that time. Not everyone did during this time, and they're going to have a need for home equity, like you said. And yeah, it should be interesting, but it's a time to start thinking of, if you have this staff and you're staffed up, how do you keep that going and consistent? You can't just rely on one way to bring in business of having a low rate. It's got to be something else. And you do have to be creative and innovative and all of that.
This is the Rundown with Rob and Rich. I'm Rich Swerbinsky with the Mortgage Collaborative, joined as always by Rob Krisman, and pleased to be joined this week by TMC Partners Credit and Verification, and their COO, Tracy King Donadio. And it's a point that is valid and one we've talked about before on this program. And that is people that coming into 2021 that were more bullish about the mortgage and residential finance market than the majority of economists. Many of them said that people are underestimating the cash out refinance part of our business. Home values are skyrocketing, creating equity for home buyers. It is not a great climate to buy a house right now with no inventory and more demand than supply. So, people are going to tap into equity in their home to improve their home that they live in currently, and that they've become, quite familiar with over the course of the last year. And it's a valid point. I think that, even in a rate environment that is less favorable than what is and has been expected by most, I do think we'll see more cash out refinances than like the Fannie, Freddie, and MBA economists were projecting this year. So,
and your average consumer, sometimes they see the prices of the houses around them. They're not necessarily thinking of buying. They see that's exciting for my neighborhood. The prices of the houses are going up. I want to make the best out of my house. And that's when they might be investing in their own home because they want, I want to stay here. My neighborhood's looking great. They're not necessarily thinking of it on this larger scale of what this means for the economy. Your average consumer doesn't know a lot about all of this. It seems exciting that, look, my neighbor's house just got sold for this. You know what I bought mine for? And, it could be an exciting time.
it's a good point. I've been spending too much time in Wall Street bets, evidently, just thinking of all homes as just cash registers and investments. But yeah, there is the legit chance, right, that people like my home is gaining value and I just want to stay here. Yep. So good segue to the next topic I wanted to get in, which is home values. And, at this point, the January data that just came out, Case-Shiller, 10.4% increase in home values nationally year over year. Obviously, there's markets higher and lower than that. That is the mean. Then we had new home sales data that came out a few days ago, beat expectations. This is newly constructed homes. The average sale price of a newly built and constructed home this January versus a year ago, up 6.6%. Tracy, I'll start with you. Concern, bubble? I'm in the camp. I am officially in the camp now where I'm starting to worry about the possibility of a housing value bubble.
Yeah, I think it's inevitable a little bit. We're kind of riding this. It can't keep going up. I think it's a little too, with numbers like that, I think that it's just going to reach a point where, where I live, I'll bring that up. There's houses that are being sold for a ridiculous amount where I am looking at my house and being like, oh my gosh, if I had sold it at this time. But then it becomes, the salaries are still the same in the people around. You're
in the burbs of Chicago?
I am. I'm in the suburbs of Chicago and proud to say that I'm a Southsider. So
like 2,500 square foot, average house in the burbs of Chicago. What's that going for right now?
In the burbs of Chicago. Well, it depends. It probably anywhere 300 for 2,500 square foot, depending on the neighborhood. It ranges. So in some of these areas that were up and coming or a little bit more, I can tell you there's a home that I knew about that 3 years ago was sold for $180,000. It was just sold for $270,000. So no real improvements made to it, but it's still the same area that, families' incomes are lower than that. It's bringing in a different kind of dynamic for who can afford that and what it looks like. So Rob's probably better versed on all of this than I see as, personally, I just see it as it can't continue to go. It has to burst at some point.
Rob, your thoughts. And part of my fear, let me preface this, is not just the value of the existing homes, is I don't see the inventory issue. I just see it continuing to worsen. This last year, people have placed a higher premium on homes, owning homes. Rates are going to be low. You got economic stimulus and an economic recovery that's going to start to happen here. And then you've got big impediments to the new construction. New construction is not going to stop, but if you look at the cost of lumber and some of the limitations on affordable labor and land, it is going to pinch the new construction market. How do you make sense of the existing appreciation of home values and some of the challenges on new inventory to help that problem?
I, for one, Rich, actually sold my house and put everything into Bitcoin a couple months ago. So I'm in great shape. I didn't do that, by the way.
You were on GameStop, right? You got all the GameStop stuff.
Yeah. So I will take an alternative viewpoint to Tracy, with all due respect.
Totally fine.
I think that I just think that 70 plus people in their late 20s and 30s scampering around wanting to own a home, whether each one wants to own a home or they're gonna get married and buy a home, even if all the millennials got married to each other. So that's 35 million couples looking to buy a home. And I'm really simplifying things quite a bit, but there aren't 35 million available homes out there. And baby boomers aren't dying off quickly enough to really add to the inventory. And to Rich's point, new construction really isn't adding a lot as much to the new inventory, a couple million a year kind of thing, 2, 3, 4 million. I don't know. When you annualize the housing starts and building permits and places available for sale, I just don't think it gets near the demand for housing that we've started to see and that we will continue to see, because frankly, a lot of the people who are out there, we're in the middle of a pandemic, or hopefully maybe toward the end of a pandemic. A lot of people have been saving a lot of money. Those who are employed, I'm employed, so I consider myself fortunate. I know there are millions of people who are not employed, but of those who are employed, they've been saving a fair amount of money. And if they don't own a home already, they want to own a home. And so when you think about just the general demographics of how many millennials there are out there, and a lot of them are continuing to work. They are not taking vacations. They're saving money, hopefully toward a down payment. The demand is very, very strong. I know, Rich has the GoFundMe site that he's accumulating money for a down payment to buy a house. It's not easy to buy a house. It's not like going out down to the Salvation Army and buying a pair of used Levi's. It's a complicated process, as we know. But when you look at the demand for housing out there, even if we weren't in a pandemic where home has a new sense of home, people are outfitting their homes, and it's an office, and it's an entertainment center, it's all kinds of things in the home. Even if it weren't for the pandemic, you would still have these 70 million people out there who are in their prime home buying years. And I think that just that demographic alone is enough to keep values from enough to keep any kind of bubble from bursting, because bubbles don't contract, they burst. I just don't see anything bursting out there. I don't see the reason behind it.
It's a good point. And
I get the burst. Yeah. It could just be, a slow.
my general sense, like after the meltdown in 07 and 08, like millennials, they didn't want any part of buying a home. It's like, I don't want to deal with mortgage lenders. Like my parents got burned on their mortgage. I mean, there was such a negative connotation to buying houses by many young people. And now I sense the opposite. Like, I'm far from deeply plugged into the millennial community at this point in my life, but younger people I know, they want to buy houses, and they're excited about it. And I think part of that is we're removed from the meltdown and the horror stories from their parents and aunts and uncles. It's a good rate environment. They've been home for a year. To your point, Rob, savings rates in America are at very high levels, and it is it's still complicated to get a mortgage, but you don't gotta put pants on anymore and go into the local bank branch. I mean, you can, it's easier. It is easier, if not easy. So Tracy, you're the closest to a millennial in this panel for sure.
God, never. Well, I'd be interested, as we're talking about it, I'd be interested. I know in studies in the past few years and would talk about how kids were staying but in their 20s were staying longer with living with their parents longer and longer. I'd be interested to where that is now, if that's changed within the last 5 or so years.
It depends if you're Italian or not.
Right. Yes. Well, I remember when, my father-in-law, who is Italian, was horrified that I was renting for so many years when I met my now husband, then boyfriend, and couldn't believe I was wasting my money renting in the city, and that I should have bought my house. And yeah, to his point, my husband was living with his family to save up to buy a home, where I was, in debt going to the bars in Chicago in my great apartment. So I'd be interested at studies to see if that's changed at all within the last few years, of how long people are staying with their families, what that dynamic looks like. Yeah, I
think a lot of them have moved out.
Yeah.
I can't believe.
Well, especially after this year, too much of a good thing is not a good thing.
Rob, I can't believe you missed the obvious Rich is in his parents' basement right now joke. I mean, come on, that was a served up softball style. So I'll just note my disappointment that you didn't latch onto that one. But
I didn't know that was your parents' basement.
Of course.
Is it?
No.
No.
Well, even if it was, I wouldn't admit it, right?
Heck, I'm here in my son's apartment, so
We've got a couple minutes left on the rundown with Rob and Rich, joined this week by Partners Credit Verification COO Tracy King Donadio. And just finishing up here, I've talked about it on this program. I'm looking to buy a house right now, and I look at values and what I think a house is worth, and more importantly, what I think it's going to be worth in 3 to 5 years. And if it was just a straight investment for me, I would not be buying a house right now, but I want a new house, damn it. And I think there's just a lot of that out there too. And, all things said, my belief is that, this is going to be a great year for the mortgage industry. I really believe that on the purchase and the refinance side, regardless of what happens with rates. And, I do think that inflation fears currently are overblown. I think Janet Yellen came out and said as much. And I think the Federal Reserve really, the Federal Reserve, and Rob, I'd love your thoughts on this as we close here, gets so little credit. Not that it's the type of, organization that's looking for credit or, it's easy to praise, but just their general handling of monetary policy in America since the mortgage meltdown has really been, you remember, you've been right here for, how long? Think about QE1, QE2, QE3, people could not stop screaming about how this was just going to ruin the American financial system. It was going to stoke all this inflation. None of that ever happened. It's been 14 years now. There has not even been one sense of dangerous inflation. Your thoughts on that premise? The Fed, I think they've done a great job. Starting with Greenspan, got a lot of shit for, what happened with the meltdown and some of the stuff in there. But from Bernanke to those that followed to Powell now, I think they've done an incredible job, and it's not easy work.
I agree 100%. I don't think they get the credit. They tend to be overshadowed by a lot of things that happen, or you hear about them like Donald Trump, lashing out against Jerome Powell, which frankly I thought was unnecessary and unneeded. I don't see the current administration lashing out against Powell or the Federal Reserve. I think they have done a remarkable job, and yeah, there was a pretty big hiccup last April when they kind of overreacted, but they didn't want a repeat of what would happen in 2007, 2008, 2009 that took months and months and months to figure out. If they were guilty of anything, they were guilty of acting too quickly. But I think they've done a very, very good job of keeping the system stable. And you're right, people keep talking about inflation. There are parts of the economy that have seen some inflation, but generally speaking, it's not the big monster that we're afraid of. So yeah, I agree, Rich. I think they've done a very, very, very good job and tend to be unsung.
Excellent. Well, we're about out of time, and as always, enjoy the conversation. Tracy, King Donadio, Partners Credit, any parting thoughts for our audience?
No, I just appreciate the time. I know we talked a lot about credit, and a lot of people have some great questions about this. And if anyone ever wants any more info, we do webinars on this that we can kind of talk to your LOs or your team as a refresher of what credit means, and can just be in general. Don't have to be a customer of ours, just have a better understanding. Our customer, I'm blanking now on her title, of course, Bethany Futrell, a customer success manager. Sorry. She does an amazing job of kind of breaking this down and talking about ways to understand credit and ways to explain it to your borrowers. So if anyone's ever interested in that, you can feel free to reach out to us, or I'd be happy to answer some other questions that we didn't get to. But that's it. But appreciate it with you guys all the time. It's always fun.
It's good to get it's good to get your name out there.
Yeah, great. They appreciate it.
Mortgagecollaborative.com, on our preferred partner page, you can find a multitude of information on Partners Credit, Tracy's contact information, and much more. Tracy, are you Cubs or White Sox?
I'm not answering that.
They're my two least favorite teams in baseball, so there's no.
Oh, well,
no
thanks.
answer to
Well, yeah. Great.
Rob, any parting thoughts for the audience?
No, I'm looking to see how Ron Santo does this year with the Cubs. Hoy Wilhelm, White Sox.
Have you ever heard the Lee Elia rant from when he was the manager of the Cubs in the 80s?
No.
I'm telling you right now, any sports fans out there, Google right now, Lee Elia, ELIA rant. It is horrifically inappropriate and laced with just crude language, but it is the greatest.
Sounds up my alley. I like this. Yeah.
It's under the
that
radar.
Sounds more south side than north side, but I'll.
Well, a lot of times you'll see, when they talk about famous coach meltdowns in sports, you'll see like the
Earl Weaver,
Herm Edwards, you play to win the game. Lee Elia, this is hands down, no close second, the best manager meltdown in the history of professional sports. It's just so horrifically profane. It's hard for places like ESPN to promote it, but Google it. It's your weekend.
Just Googled it.
Yeah, it is.
That should be our closing fade out to him just wearing rants. Yeah.
All right. This was the rundown with Rob and Rich and Tracy King Donadio from Partners Credit. We will see you again in 2 weeks from today, 3 p.m. Eastern, every other Friday. Until then, Have a great weekend, everyone. Take care.
You too.
Bye. Thank you.